Hello, folks. Hello, hello, hello. This is Victor Jones from ThinkorSwim, and you're listening to the Options Hour on TFNN. For the next hour, we're going to be talking, basically everything options. Futures options, stock options, what's happening in the underlying market, so that we can put on some high probability positions and kind of navigate what's happening out there on the market. As always. For the next hour, we'll be taking as many of your questions as possible. If it's your first time listening, essentially you get to call in at any point during the hour, ask any question on an underlying security or maybe a position you have on, or maybe an option strategy you've been considering. No matter if you're just starting out, you've been trading for a while, feel free to give us a call at 877-927-6648. Again, domestically, that number is 877-927-6648. Just to get us started off here. Interestingly enough, we had a small rally this morning. We kind of gave back some gains. If you were watching or listening, Ben Bernanke, gave testimony here today before the Senate Budget Committee, and it was interesting. While he was speaking, the market gave up a lot of those gains, and we sold off to about the 13.32 level. We're now trading $10 higher at 13.42 and a quarter. Just to quickly give you guys an update of where we are in the market. Again, the S&P 500 13.42, even up $3 on the day. The Dow Jones, $12,820, up $44 on the day. The Russell, 826, even up $1.30. And the Nasdaq, 25.30 and 3/4, up $5 on the day. As always, we like to quote a couple of our commodities out there, and one that we've followed here for quite a long time. We rode the roller coaster up, we rode it down, and now we're on a small retracement from that sharp move down the 1500 level. But gold futures, 1,740 and 40 pennies, if you want to call it that, up $15.50. Quite a significant move on the day. And then you have crude futures, 98.60, up $1.69. And how many times have we talked about crude oil in the range it's been essentially playing in between 98 to 103? And we're going to talk just a little bit about that range here coming up. But interestingly enough, we tested the 103 level and last week, or actually it was 2 weeks ago. I was gone last week. Chris Bolson filled in, and 2 weeks ago when we were both on the show, we talked about that range. We talked about kind of where we thought that risk to reward scenario was at 103, and the risk to reward favored a downside move there at the 103 level. So if you're looking at a range bound market, well, where's the potential there with crude? Do you want to buy that base at 98, or you want to sell that peak if in fact that's your hypothesis at 103, and 103 we figure the risk reward favored the downside. And interestingly enough, 2 weeks later, here we are at 98. To continue here, the Dow trading just a little bit above 132. Interestingly enough, we were taking a look at this just yesterday when we were talking to Tom and the show about 4:30 Central Time, 5:30. All you guys up along the Eastern Coast who had the pleasure of probably cheering on one of the two teams here in the Super Bowl. Great game on Sunday night. Unfortunately, Tom Brady couldn't pull it out. But one of the things that we were talking about, if you look at the dollar levels, we just did a quick check. It wasn't any research or quantitative research associated with it. It was just where were we 5 years ago? Where was the dollar 5 years ago in comparison to where it is today? And essentially, we were very close to unchanged. If we look at what conditions were about 5 years ago, we took a look back on the charts here in ThinkorSwim. We had the Euro USD trading right above 130 or so, 1.30, in between 130 and 131. So we've had some highs, we've had some lows throughout that time, some strength and weaknesses in terms of the dollar, and we'll continue to monitor. We want to talk about that just a little bit today because obviously, Ben Bernanke, he came out And we did sell off just a little bit while he was speaking, and surprisingly, he didn't talk about the jobs number that were released on Friday. He actually signaled that the U.S. market, the labor market, has a lot more room to go in terms of growth into the future. So interestingly enough, he didn't accentuate the positive on Friday. He came back and said, "Hey, this is what we still have to do," and just kind of signaled again that he was determined to keep what's happening, obviously, in Europe, the European credit crisis, away from the U.S. economy. Very difficult, I think, in our global economy to do, but the signal was, somewhat strong. So we'll see what that means to securities like, the bonds, the notes, 10-year. We'll see what that does to corresponding ETFs out there, the TLTs and TBTs of the world. And so we'll talk about that here coming up as well. As always, after we do our quick market wrap up here, we're going to jump into a few securities. A couple have had earnings, a couple are going to have earnings, and a couple are just interesting plays. 877-927-6648 if you got some ideas or questions of your own. Again, everyone out there, 877-927-6648. So we want to quickly talk about Coca-Cola, because whether or not you're a short-term trader or you're a long-term investor, or whether or not you're looking to, with everything that's happening here, you're trying to get some global exposure or not. Coca-Cola, I mean, you couldn't pick a different company that had more global exposure, I think, right now in terms of highest market cap with global exposure than Coca-Cola. So, you've got Coca-Cola, which is symbol KO. There's a few underlying, the company itself has trades under a few different tickers, but KO, Coca-Cola, 68.79 today, up 76 cents, a little over 1% up on the day. And so interestingly enough, they came out with earnings this morning before market open. Net were down, net revenue, but sales had actually increased. And they've announced some plans to kind of cut costs a little bit around high commodity prices. So, whether or not you trade futures, whether or not you trade, Forex, or you understand what's happening with that dollar, it does affect different underlying positions. And Coca-Cola is, one of those positions. And we look at the range that essentially it's set over the last five expiration cycles. And if you've listened to this show over time, you kind of see that we're prone to picking out these ranges. It's interesting, you have option traders that are utilizing or applying technical analysis. You listen to Kate right before this show. Those different elements definitely play into the options world in making high probability decisions. So you've got this underlying security that's traded in a range from essentially a 65 level on the downside to about a 72 level on the upside. The 52-week high was 71.77. I'm going to round that off at 72, but essentially every time it gets to about 71, it runs into a little bit of selling pressure. So 65 to 71, and you're essentially seeing a mid to upper part of this range right now at 68, 69. So if you're playing it from a probabilistic standpoint, you think to yourself, yes, there could be a catalyst here to push us higher, but we've just had earnings. What could essentially really move this market to the upside? A swift change in the dollar, a swift change in the underlying commodities that make up Coca-Cola in terms of wheat, corn, grain, those types of things that make up, some of the products that come out of Coca-Cola. If those things do change, there's the potential to reprice, but if we're just looking at technical perspective, we're just looking at price action and what price action has told us, it told us we've essentially got maybe a $2 upside here. We got a $2 upside on the downside from $68. We've got about a $3.75 downside. So you've got maybe $2 of room to run on the upside, and maybe potentially $3 of risk to the downside at 65. So, as always, one of the things we didn't cover in our initial market wrap was the current VIX levels, and we're here sitting at $17.60. Really, 17% is really what that is. So 17% is what the VIX is telling us on the S&P 500 at 1342 now, up about three ticks from where we last quoted it. But 1760 here in the VIX And we've continued to talk about this downward level shift in terms of where we are in volatility. I mean, when we were sitting at the 35 to 45, we mentioned that. When we broke the 35 level, we talked about the new level, 35 to 30, and we broke 30, and we said, hey, there's room to play here from 30 to 20. And now we've essentially, I got to be honest, this move to a sub-20 VIX is something I didn't quite see. I didn't quite see a movement. It's such a swift amount of time. Essentially, we're at the early part of February. We're already below a 20 level in the VIX. And for some of you, if that term is new to you, that VIX or volatility in general, essentially what we're measuring here is the fear gauge of the underlying market. The VIX is, or could be considered, a fear gauge, and the higher the VIX is, or higher the level of the volatility, implied volatility, S&P 500 options, the more uncertainty about price distribution and where we could be in terms of price levels in the VIX. So if you remember May 6th, that infamous date May 6th, the flash crash, you had implied volatility levels upwards of 90 to 100%. Depending on if you were just looking at front, back month, or just the VIX, anywhere, let's call it 80 to 100%, depending on what instrument you're looking at. Some were as high as 120%, which essentially means there was almost no confidence in what was happening in the S&P 500. We figured, hey, we could either double or we could go to zero, which we all know is a low probability of actually occurring. But when you get some anomaly like that, and you have that high volatility, there was opportunity to really start taking advantage of that extremely high volatility, because we know that the probabilities that we actually go to zero in the S&P 500 is, well, let's just say if we do that, you've got more problems to worry about than your brokerage account. So now we're looking at the other side. We're looking, where have we been, and where are we, and where are we going? So we've just now level shifted below 20, and I want to show everyone out there, because I think as options traders, we've essentially grown accustomed to trading with volatility over the last, let's just call it 3 years. I mean, we've grown accustomed to a certain level of volatility over the last couple of years, and we've had a few dips to this sub-20 range, but it's really been few and far between. We've been positive 20 much more often than we've been sub-20 over the last couple of years. I mean, you can see it as I go back through the chart. If you're watching through the Tiger Den, I want to welcome everyone that is watching, and I'll encourage you guys to give us a call if you have any questions, you want to talk, at 877-927-6648. I'll post that in the Tiger Den for you guys as well. But you can see that over the last 5 years or so, we have been positive 20 in the VIX much more often than we have been sub 20. So what that essentially means is we as option traders need to adjust, if not our strategy, at least our thinking. We've got to, if you're used to essentially being, let's say, if you're used to being, let's call it, 3 strikes away, and now you're actually getting, if you're selling, let's say, a call spread, right, or a put spread, you're selling some vertical spread, and you're used to being able to get maybe 3 strikes away, and you're noticing that as of later, over the last 5 to 6 expiration cycles, now you're 2 strikes away, now you're 1 strike away in order to get the same amount of credit for something that you're used to be able to go 3 strikes away. So I think if you're not adjusting your strategy, you're at least adjusting your thinking right now. And to have some expectation on whether or not we will be, or we'll continue to play at this sub-20 level, I think is really, really important. And, I've got to be honest, as we continue to rally, this is such a strong rally from the 1100 level. Basically, we've rallied over 250 points. With only, I'll call it 2 corrections. We'll call it 2 quick corrections that we had basically in November, and then one towards the December expiration cycle. Into expiration, there was a small correction from 1250 to 1200, but we knew that range. I mean, essentially, we had been trading that 1200, 1265 range, for a couple expiration cycles there. So we almost expected that into December, a correction off that 1265 level, and we got it. So I don't know that that was so much of a correction, more than everyone was saying, hey, we're at the upper part of a range, and it's really, really light volume. Pretty easy to take the market down in that particular situation. Now we've got after December, you're seeing a little bit more volume come back into the markets, a little bit more institutional partners or institutions that are coming back into the markets after they had kind of called it a year into the end of 2011. So you've got all this participation. The candle lengths, or in other words, the ranges that we're seeing on a daily basis are condensing, and that we can see that obviously by how much the VIX has come in. So the ranges that we're playing on a daily basis, they're no longer those 20, 30-point swings, those 15, 12-buck days in the SPOOs. We're talking here about, $4 or $5 moves one way or the other. Very, very different situation, very, very different trading mentality, I think, for a lot of us who might have been able to sell a couple call spreads or buy account. Well, maybe not a calendar, but sell a couple or buy a couple call spreads, whatever you were doing. You get so far either into the money if you're long if you're long the vertical, or out of the money if you're short the vertical spread, that you're able to essentially close it over a couple of day period. And the market isn't giving those opportunities right now. So we've really got to start thinking. We probably switched our thinking to earnings, and we played a couple earnings. Google, Amazon, Apple, all of these different instruments gave us these big moves to kind of play with, a little bit of volatility, and so what we're looking at here is a continuation of very strong trend to the upside, and we're approaching this 1350 level where we're at the mid part of last year. It'll be interesting to see how the market performs here. But again, you're seeing we're inching higher, but we're doing so. The market's not overcommitting on a daily basis. We're doing so at $4 and $5 increments. We have had a significant move from the 1100 to 1350 level, but at the same time, we're doing it in a very, very controlled pace. So it'll be interesting to see this trend and what that correction, when that correction comes, and exactly how big of a correction that we see there. Because we did have a few healthy ones at least one healthy one in November. So I think what we need to kind of look at here is we've looked at the VIX, now we're moving sub 20 levels, and we're doing so as we approach sort of, I'll call this a resistance area, because if you do look back in mid-May, I'll call it about mid-May, we played around the 1350 level just a couple of times actually throughout that expiration cycle and into the June expiration cycle. We also hit it in July and August as well. So we've bumped up along this 1350 level quite a bit in the past, and it's made for a technical resistance level, and we'll talk about how that plays into overall underlying strategies. But I want to take a moment here to jump into some actual underlying names. We'll tie it all back to the underlying market here. We've got some interesting chatter in the Tiger Den. I think someone said, interestingly enough, that when this is a time to just close your eyes and buy and go long, and some other people have noted when you start to hear that type of that thinking, that's the time to lighten the load just a little bit. But you know what? I think in most cases where you start to have a lot of those outlets come in and say, hey, let's go long here. Everything looks good. Well, let's look at some earnings announcements here, really. Let's look at Google. Let's look at Google, who came out and had, decent earnings, but essentially said, we see in this particular space, we see a little bit of cost saving going on. And the same thing happened with some chip makers going into I want to call it the last 3 weeks or so. Some chip makers came out and said, hey, we foresee the next year being a little bit tough. So you see all these people that were essentially on the tech side that were doing well on the earnings per share, on the top side earnings, but in terms of their forward-looking forecast, other than Apple, as companies were looking forward to the next year, they were seeing a little bit of economic headwind. And so I think that's interesting to me when you start seeing that as a reoccurring theme in all these companies that are reporting. Everyone that's reporting is saying we see, increased economic headwinds. We are, as in the case of Coca-Cola, we're going to be doing a little bit of cost cutting. In their case, it's a little bit different because it's high commodity prices, but same thing with Starbucks. All these different things that are out there in the marketplace kind of point to a different direction than we're seeing the market going. So I think, we just, not saying to be cautious so much, but be aware of kind of all these market dynamics. So what we'll do here is just take a quick break. We talked about Coca-Cola. I want to give a quick market update just so we're all in tune with where the market is right now. And I think we want to jump into Cisco, because I think Cisco is going to be really, really interesting. We've had so many precedents as we come into the tail end of earnings season. We've had so many precedents set in the technical space that it'll be interesting to see what Cisco comes out and says. But let's do a quick market wrap here. S&P 500, the SPOOs are trading 13.42 3/4, up 3 3/4 tick. Hasn't moved since the last quote. 12,824 on the Dow, $47, up about $4 since the last quote. The Russell 825 and 30 cents in change, up 60 cents. Up a couple cents since the last quote. The Nasdaq $2,533.25, up 7.25. The VIX still steady at 1760. The dollar one spot 3256. And the dollar index, just to quote that, because I think it's important to give context to what the dollar is actually doing. The dollar index 78.64.5. Let's round it up to 78.65, down 54 cents on the day. The dollar index being something that measures the U.S. currency versus a basket of foreign currency, so we can actually get a relative performance of the dollar versus a single performance. And if you're watching in the Tiger Den, I actually have the ThinkorSwim platform actually has a visual representation of any currency versus other world currencies. So you're seeing here, I'm weighting everything against the dollar, and you can see that relative to these other currencies, or what those other currencies are doing against the dollar. And so if we pull up DX here, you can see the same thing that we've essentially been looking at. We've been looking at the dollar. We've been looking at oil. Clearly, as Chris made a great point a couple of weeks ago, the correlation between the dollar and gold is much stronger than it is between the dollar and crude. But still, there's some information to be had out of that market. And as we saw the dollar climb higher and higher, the strength of the dollar gets stronger and stronger. We were also seeing that crude was climbing to higher and higher levels at 103, 101, 102, 103, and that was clearly due to the conflict that was taking place and kind of inflating those prices just a bit. So we were watching the dollar and saying, hey, does this make a lot of sense in terms of pricing, other than the potential scare, and what is the realistic probability or something like that to happen. So we've been monitoring that. We've been looking at that. We've been trading that just a little bit, and now we're seeing a move off that 104, 103 level, a nice little move down to 98, which has really been a base for crude over the last couple expirations. Again, I think we're a little bit more cautious to play the bottom side. We're a little bit more cautious to play that bottom side than we are to play the top side, selling call spreads versus buying call spreads or selling put spreads, just because I think that opportunity for a little bit of that inflation, a little bit of that inflated price in crude, the opportunity for that to come out is in my opinion anyway, is there a little more so than the opportunity for it to bust ahead of that 103 level, at least in the current environment. Again, something could come out and say, we could reprice the dollar, we could conflict could strike a little bit more and really start to threaten those inventories, those oil inventories, and we could see a move above 103. But until that actually happens, we've got this nice trading range between 98 and 103, and the risk to reward favors playing a downside move. But moving into Cisco here, which I think is really I want to call it important, but you might have got the impression that we tend to be a little bit more technical here at ThinkorSwim. In other words, we keep our eyes on those technical companies out there. And as you've seen, Cisco over the last couple of expirations, has been slowly trending up. Let's call it from $18 to the $20 level. And I think it's a move that not a lot of people are talking about. If we look at the most active securities on the day, on the NASDAQ anyway, is something I've been watching today. The most active securities on the NASDAQ exchange by volume is Cisco. It has about close to 4% of the total market on NASDAQ. today with about 34.6 million shares traded. So a lot of activity going on in Cisco. The price action, it's only up 0.5%, which at $20.27, it's up about 8 cents on the day. So it's up 0.5% on the day. But there's a lot of activity going on here, which means there's a lot of people preparing, I think, for what's upcoming here with their earnings. So you have a lot of volume here. And what I think is interesting to go into the chain, what we always like to do, and I'll actually do this really quickly. You can see we'll add CSCO to our watch list, and on ThinkorSwim Technology you have the ability to not only monitor volume, which I've just quoted you, again it's 4% of the NASDAQ today, but the Sizzle Index in ThinkorSwim is telling us about 1.8. That means essentially 80% more options are trading today than the typical 5-day average, or than over the last 5 days. And that's, of course, because we have earnings tomorrow, which are coming, as you can see on the screen if you're watching the Tiger Den, after market close, and that is confirmed. So we've got earnings tomorrow coming after the market close, 80% more options trading than the 5-day average. Interestingly enough, more of those are trading on the put side. So you've got 2.1, or basically 100% more puts trading than usual, and you've only got about 60% more calls trading than usual. You got to be careful about the way you infer that information, because if I'm going long, right, if I'm going long into earnings, and clearly there's a lot of volume here, so I'm a market maker and I'm going long the security, how do I hedge my position? Well, I've got to potentially, I've got to buy puts and sell calls. So there's a give and take there. You can't always read into it. There's more puts trading, so it's more bearish. But if you're just looking at a straight put call ratio, or you're just looking at how much activity is taking place here, there's more activity on the put side. If we take a look at what's actually happening in the chain, as always, we want to look at the vol skew. We're looking at the February weeklies here. The February weeklies are telling us there's a 72% implied vol in the front month. So volatility in the front month is telling us about a 72% move, which over this next 3 days would account for about $1.20. That's a plus or minus move of $1.20. So Cisco's trading at $20.28. The expected move here for the next 3 days is $1.20, meaning from now until expiration, if you are going to try and play those weeklies, and you're not just going to play it for the one-day move in earnings tomorrow, you're going to play it until Friday expiration, you got to be aware that the way the market is priced today is telling us there's a potential move of $1.20, which means we could be trading as low as $19 or $21.40 on the upside. So $21.40 to $19 is essentially your expected move from now until Friday, given how the weeklies are being priced. So if you are someone who's going to try to play Cisco earnings, it's very, very important that you understand or that we get this information out of the options, because so many times we see somebody come into an earnings situation and say, I'm going to buy calls because I think we're going to have a positive move. And what happens is, yes, you're going to have a positive. You might have a positive move, but if you haven't, appropriately planned for that move or the realistic expectations of that move, the potential for success there is very low. And let me explain what I mean by that. In the ThinkorSwim software, I'm going to add the theoretical price, or I'd like to show the theoretical price right now of the Feb weekly options. So I'm going to look at the weekly options, which expire here this Friday. Okay, the 21 calls. Okay, the current underlying market is trading at $20.28. The 21 calls for these weeklies are trading at 24 cents. They're 24 bid at 25 cents. So essentially, the mid price of the market is right in between, 24.50, or 24.5 rather. So I'm going to add implied volatility here. The implied vol is about 62% here of these options. Now, what happens if the stock price moves up $1? Okay, stock price moves up $1. I paid, let's call this 25 cents for every one option I buy. So I'm thinking, you know what, there's going to be a positive move here. If we move to the upside, I'm going to buy one strike out of the money, and that way they're cheaper. I can buy more and then profit even more. So I'm assuming a $1 price move. Now they're Thursday after the close, which means I'd have to hold them into Friday. So I'm going to move ahead, as you can see. I'm moving ahead to Thursday. Okay. Now, volatility in the front month is 72%. Volatility in the back month is 50%. If I even go one more out, it's 33%. So the difference in implied volatility is as high as 40%. If we just take out, we got to imagine once there's certainty that returns to the marketplace, right? Once there's certainty that returns to the marketplace, what's going to happen to the implied volatility of these options? It's going to really drop out. You're going to have implied volatility that really cuts out here. The expected move, or the range that you can see in the market maker move due to earnings, is $1.07. So if you're looking at just purely what is the expected move based on earnings and not until expiration, it's $1.07. So that's plus or minus. So if Cisco does have positive earnings, we would expect no higher than a move of $1.07 to the upside. That doesn't mean we'd move exactly $1.07 to the upside. There's essentially a 68% chance that if we move up, that we move up less than, $1.07. So that means our adjustment is realistic, but maybe we see a move to the upside of 80 cents or something like that, and volatility comes out 20 cents or 20%. Now, if we hold that into Thursday, what does that actually look like? We've potentially bought something at 25 cents on the offer. Our theoretical price here is only 30 cents with an 80-cent move to the upside and a 20% drop in volatility assumed. Okay, if we move out to February 9th. Now, in this scenario, we made a little bit of money, right? But we only made 5 cents on every option. Now, for some people that are looking at that, they're like, hey, that's a 20% return on a 25-cent option. So if you're looking at it that way, then yes, but essentially, what's the risk you took on? Well, you took on 25 cents of risk to make 5 cents. So, I think when we're looking at risk to reward, the ThinkorSwim software allows you to essentially look at these theoretical prices, stress test the possibilities here. Say, okay, if we actually move up, let me see what is the expected range on an upward move or a downward move if you're playing the downside move. And let me take out implied vol here. So let's say if implied vol comes out even more than that, and we come out, let's say 40%, let's go 35 just to show what happens here. You can see the potential if implied volatility of that vol skew flattens out to around 35%. You're going to see that the theoretical price of your 21 strike option, the call, and you're thinking to yourself, hey, we moved up 80 cents, I'm in a good position here. If volatility comes out of that marketplace or uncertainty comes out, you've now got yourself an option trading at 21 cents. Which is less than 20 to 21 cents, which is now you've lost 5 cents on that initial investment. So the reason we show that, or the reason I like to show that example, one, if you're new to trading options, this shows you have to be cognizant of the different forces that are in play when you're trading options, especially when you're trading earnings. There's time that's factored in here. There's the stock price, and there's volatility. There's some other factors as well, but let's just say date, or in other words, time, stock price, or the underlying move, and then the volatility move. If you're not aware of what happens with volatility, you could really get hurt, or things could go in your favor, and you're not really aware of why you might lose out on something like that. So the opposite way to play something like this here, the opposite way to play something like this would be to say, okay, I'm bullish. How do I, potentially make a little bit of money here? Well, if the downside potential, right? The downside potential is to move to 19 basically between now and Friday expiration. If I were to sell the 20 and 19 spread, I bring in about 30 cents to do that, which essentially means my break even is 1970. So realistically, between, I have about 70 cents in risk there, and the probabilities of that actually occurring are a little bit high. If you think there's going to be a positive move or even a flat move, you stay at 20. That's something you actually stay, you keep a little bit of money in your pocket for doing. So we're going to move on here, but I did want to talk about Cisco. If you have any questions, you're planning on playing Cisco, or you've got a current position, give us a call at 877-927-6648. And I think that's a good transition. We want to give a quick market wrap here, talk about what the market is doing, but that's a good transition into probabilities, using options to trade in a high probability or high probabilistic manner, if I could be so bold to use that term. So the market wrap up really quickly, 1343 in the S&P 500, 1342 3/4 now. We're up about 3 3/4 to $4 in the SPOOs. The Dow Jones now trading at 12,827, up $51, up about 4 points the last time we quoted. The Nasdaq 2,532.5, up 6 3/4. So interestingly enough, you're seeing a little bit of diversion there between the SPOOs and the NASDAQ. You'd probably expect to see the NASDAQ a little bit stronger. Not too much of a divergence there, but just interesting. The VIX climbed up a penny, 1761, now down 15 cents on the day. The VIX movement is correlating with the positive movement in the underlying market. What I always like to look for, especially intraday, is a positive move, a small positive move. Maybe we're up $1 or $2 in the SPOOs. Maybe we're up $10 to $20 or relatively unchanged in the down. You see the VIX that's actually up. I always like to look when the VIX is not confirming the price action, because what that tells me is there's a little bit of fear in the marketplace. People are buying up protection. There's a little bit of uncertainty with that positive move, and in some cases you'll see a change in the VIX. In some cases you'll see a change in the underlying move. Maybe you'll see a reversal back down to unchanged or negative territory. So I like to look for those different things. In this case, the VIX is confirming the positive move on the day. And gold, 1745, 70 cents, up $20.80. To quickly talk about gold, because I think again, this is an interesting level here. We're now approaching, we're almost there, we're at 17.5. We're approaching that 1800 level that we saw before in gold when we had this, a pretty hard crash, pretty hard sell-off. And now we've sold off to about 1550. We talked right around 1600 after we recovered from 1550. That 1600 was an interesting support level to start thinking and nibbling on a bit of a long position. That's worked out over the last two expirations. Now we're trading 1750, which is a bit of a mini resistance area. You had a close above 1750. The next day, immediately, you had what's very, very close to a bearish engulfing candle. Fortunately, you didn't open higher than the previous day's close, but you did have what was very close to a bearish engulfing candle here, but we weren't higher than the high of the previous day. But we did engulf the entire body of the previous day, which is typically a very bearish sign, and you had continuation on the next day as well. Now here, you're almost seeing the opposite. You're almost seeing a bullish engulfing, but unfortunately, that it's very, very. The open of today's candle is very, very close to where we close, if not exactly even to where we closed on the previous day. So you're not exactly seeing that, but candlesticks are not always. It's not always an exact science. So here at 1745, we're looking at /GC. Let's take a look at some option positions on GLD. Here, as we approach in that underlying market about the 170 level. So as we approach the 170 level in gold, the question is, if you're going to start nibbling, are you nibbling on the long, or are you nibbling on the short side? And I just love to use the term nibble. So we'll go with that. But essentially, you have GLD, which is trading 169.52, and you think, what is your short-term upside here? It's potentially 175. Now we're in the middle of an expiration. You've got about 11 days left in February expiration. Typically, you're taking things off 4 to 10 days into expiration. Excuse me, you got 10 days into expiration, 11 into that Saturday expiration. So typically you're taking things off, and if you are, going to put on some sort of, or look or price out some sort of move, you say, what's my upside here? What is the upside here? In terms of technical analysis, if you price this off at 175, if you're just going one wide, 13 cents. So you can see the market has already essentially priced a low probability of hitting that 175 level between now and February expiration. Interestingly enough, though, in March, if you price out the 175, 176 call spreads, you're going to get very close to 25 to 30 cents. And here we've got 26-cent move, or 26-cent price on one vertical spread, which means you got about a 75% chance of success if that position was put on today. Now, again, that's making the assumption that we've had a rally here in gold. We had a pretty bearish candle in the futures market. The ETF market doesn't necessarily confirm it, but you did have what could be looked at as a spinning top there right around at 170 level. So, we're looking right here at 175 and what that potential opportunity is to go a little bit short. If you were going to look at putting on a position like that a little bit early, because you are a little bit early, I think if you look at what your real upside is from 170, I think 185 would be a comfort level to start thinking about a real reversal here. But I think when you look at gold, an $1,800 level or $1,750 level in gold, historically is an extremely high price. And we're past kind of the seasonal high of gold. Into the end of the year is typical when you see that seasonal high, and right in the beginning of the year, you're seeing a move to what that seasonal high was at the end of last year, which is interesting. So to start nibbling on that potentially, you look at that 175 and you say, that's the potential support or resistance level, and maybe you construct a vertical spread around that technical resistance level, which, again, gives you from a probability standpoint, a 75% chance of being successful. The one thing I would note is you probably start off a little bit small. If you have a little bit of a rally here, and you are seeing an extreme rally here at 22.20, and a lot of people ask, well, why would you look at selling call spreads on the day you're up $20? Well, that's when you get your best prices. I mean, a lot of people might look at selling the call spreads when the market's down 20, but what do we know historically about what happens tomorrow when you have a market that's extremely, extremely oversold today? Typically, if nothing else, sometimes you see a continuation of that, a very strong continuation of that. Most times, I'll venture to say, at least lately, you see some sort of stabilization, if not a small rally. So that next day, you're essentially looking at worse prices than you were on the day that you were trying to catch that down move. So, typically when you're looking at this stuff, if you're looking at it with a contrarian mindset, and the market rallies $20, you're thinking to yourself, hey, is this a good or potential opportunity to set something up for a potential correction? On the opposite side, if something sells off $20 to $30, I'm making $20 to $30, but obviously that's dependent on the percentage move. Something sells off or rallies 2, 3, 4, 5%. That's an interesting time to take a look at what could potentially happen over the next couple of days for a short term. So I think what we'll do here is we'll give everyone the number one more time. We've got about another 12 minutes or so remaining in the program. I would encourage anyone to give us a call. So we're looking at 10 days to expiration. You've got to have some positions on. You're thinking about how to roll up, how to roll out, how to put a new position on for the next month, whether or not to put something on for this February expiration cycle, or look at doing it out in March. Let's talk about that. Let's talk about those questions. 877-927-6648. Now, we talked a lot at the beginning of the show about volatility. We talked about the VIX being down at the 1750 level and what that potentially means. And whenever volatility is high, wherever we have a spike in volatility, we always get the questions of, is this a good time to put on a calendar spread? Well, it's so interesting to me that those questions never come up in periods of low volatility, when you do have a higher potential of a spike in vol. I mean, the reason people think about calendar spreads is because it's positive volatility. You get positive theta, but it's also positive volatility. I guess it's positive theta depending on where you position that calendar, but it's positive vega. So as volatility increases in most cases, you're going to have a positive impact to the pricing of that calendar, as that back month's a little bit more sensitive. So at these periods of low volatility, when these calendars are relatively cheap, it's interesting that those questions don't come up as much. So if you're someone looking at the VIX, and if you're someone looking at the overall market at 1350 here, and you're thinking, gosh, there's got to be a correction coming. or I want to position my portfolio to take advantage of a potential correction, or at least hedge off the possibility of a correction. Okay, that's very, very different, because I think a lot of us, at least listening, it's not like you're flat all the time. You're just putting on small positions to nibble in one way or the other. I would venture to say a lot of the people listening here have a core position, and they're trading around their core position. You might be long some underlying security, and you're selling calls against it to bring in income. You might be long, some 5, 6, 7 to 10 stocks, and then at the same time you're putting on short call spreads on the spiders, short call spreads on the diamonds. You're doing some sort of hedging that's offsetting potential move to the downside. And I think here at this level, it's important, if you're looking at doing that, do that at the same time. That we're actually looking at the underlying price of volatility, essentially, and what that means. So here, if we look at the spiders, we're just going to pull up SPY 134.73. You can see it zoom past the fib retracements we've actually got on the chart here. But if we're looking at the underlying market here, and we're 135.73, we're thinking to ourselves, where might we position a calendar? If you're expecting a calendar to potentially pay off, you're expecting increase of volatility. In those cases, you're probably predicting, or expecting, I shouldn't say predicting, you're expecting a little bit of a sell-off. So positioning those calendars to the downside, seems to make a little bit of sense. So here in Spider at the 132 or 130 level, what those calendars essentially look like is kind of interesting. You've got, if we're on the put side here, let's say we buy a calendar. Well, the calendar, the Feb-March calendar in the spiders cost you about 141. Well, why is that interesting? Well, you've got only 10 days to expiration here in February, and you're selling the 132 put, which brings in about 50 cents. So it brings in 50 cents, and you've got implied volatility there about 16.2. You've got relatively low volatility. You look in the back month at the 132 put, and you see it's about $1.90, $1.91 at about 18% implied volatility. So what happens here? The percentage or the probabilities that between now and expiration we go down and expire lower than 132 is 24%. So essentially we're saying that there's a 76% chance that we expire above 132 between now and expiration. So there's a 76% chance that we keep the 50 cents for that 132, and we just distribute that to what the cost of our 132 put would be at 190. So essentially you're buying a put or 132 in March for $1.40, if you want to look at that like that, with about a 26% chance that you get assigned on that short put. Now, what happens? Well, if we look 10 days in the future, please remember we've still got this theoretical price tool that's available in the software. So if we go forward past expiration, we'll go right to the Monday. Well, let's just say we're sitting right where we are. Volatility has not changed at all. What's the theoretical price of that 132? Well, it's 140, a little bit. So it's right around $1.40. So if the idea is that we would potentially rally or that we would potentially sell off just a little bit but not an extreme amount, let's say we go down just a quarter from here. Oh, let's say 0.25 move to the downside. What does that do to that 132 put? Well, it's $1.47. So essentially what you get there is the ability at some point to come in and say, all right, here I'd like to sell the 133 above it if we rally just a little bit. So you sell the 133 above it, and now you've got yourself a short put spread. Or if you do have maybe a short-term correction, you've got a put in there at $1.40 at a reduced cost price. If we sell off just a little bit but not a ton, you've made a little bit of money on that 132 put. So it's a little bit of a risk protection here. And if nothing happens in these 10 days in February, you're noticing that put, that 132 put should be equivalent. It should be trading right around 140, 142, or whatever the case is. So you essentially got yourself some protection to the downside. a little bit of protection. So if we come down to 132, and I'll just show everyone visually what this means if you were to buy a calendar spread at 132, and I'll analyze this trade, you can see if we actually move down to 132, you'll be profitable right around that strike. You've got kind of 5 points to play. If I just set my slices to break evens here, this all depends on volatility, but you've essentially got yourself a range between 129 and 135 that you would be profitable in the calendar alone and paying $1.41. And if you don't move, if the market doesn't move significantly, you've got that 132 put basically after February expiration that's going to be worth somewhere around 140. So it's kind of I don't want to say it's a costless at that point. If that scenario works out, it's a costless hedge, but there is some risk involved in it. And if you do go down to 132, you'll go long the spiders. But again, if you're overall bullish in your portfolio and just looking for a short-term hedge, you're thinking to yourself potentially, hey, at a 132 level, that's much more attractive than where we are at 134. So these are all things that could factor into the strategy, the thought process that you could be putting on. And again, if you're long securities, you're long a portfolio, these positive Vega trades or going long any spread is actually relatively cheap here than it has been over the last 4 or 5 months, especially the last 4 or 5 months. So as we wrap up here, we've got about 2 minutes. I just want to go ahead and give another quick market wrap. We've talked about a lot of things today, so I want to appreciate everyone listening for the entirety of the hour. We've talked about Coca-Cola. We've talked about high commodity prices and what that did to their forward outlook. We talked about upcoming Cisco earnings and what some of their predecessors, what some of those chip makers have kind of forewarned about what's happening in the upcoming year in terms of Cisco. We'll see here tomorrow after the close whether or not Cisco kind of is burdened by some of those same forward-looking forecasts that the rest of that sector has essentially been burdened with. And then we've also talked about the VIX, the volatility and the shifting levels in the VIX, how we're now below the 20 level in the VIX, which historically, or at least over the last 5 years, is we've been here a relatively low percentage of the time, a low percentile of the time. We've talked about how that plays into the strategy, how that plays into your thinking as we start to put on these newer positions in this new kind of volatility level. And one of those being looking at calendars to potentially hedge these positions at these low volatility prices as we potentially expect a spike in volatility, if in fact that's what you're doing. Whether it's speculative or whether you're using it as a hedge, all these different things kind of work together. And a calendar, again, buying the front month at a strike, selling the front month at a strike and buying the back month's put or call at that same strike. So I want to thank everyone for joining. We appreciate the hour show. We will see you next time, next Tuesday, same time, same place, Options Hour on TFNN. Thanks, everyone, and have a great week.